Well, it sure is nice to be back after spending a few weeks over in Europe, particularly visiting Scotland and some of the distilleries that we like over there. Always nice to go away, but it's always nice to be back home as well. In all seriousness, it was very nice to go on vacation, but it's always nice to come home as well. Back with you now. Today's episode is going to be all about the numbers. We're going to look at bank earnings, inflation, and some other economic data that will help you with your investments. In this video, we're going to preview the upcoming bank earnings. What can you expect? Canada's inflation rate went down in April. Is this what the Bank of Canada needs to start lowering interest rates next month? We're going to look at two trains of thought on that. Also, we'll look at what one of Canada's top economists has to say about where we're headed. Today is Wednesday, May the 22nd, 2024. Let's get started with today's top stories. It is pretty hard to believe how quickly a quarter goes by, but it's earnings season again, and our big Canadian banks are set to share their latest results with us. TD will be kicking things off tomorrow. That'll be followed by the other major banks next week. It is expected this go around that the banks will report slower profit growth in their second quarter earnings. They're citing mostly high borrowing costs and slower economic growth as the reasons for that. Analysts are predicting earnings could drop as much as 4% when you compare them with earnings of last year. This would follow a year that has been marked by increased reserves for potential loan losses. We're seeing that over and over and over. Also higher costs and, of course, stricter capital requirements. Bank of Montreal analyst Sohrab Movahedi, he notes that while earnings trends might improve starting this quarter, there will be some pressure remaining from slower growth and persistent expenses. He says, "We believe that the Canadian bank earning trends are close to an inflection point. Last year's triple whammy of higher minimum regulatory capital requirements, credit reserve building, and negative operating leverage from double-digit non-interest expense growth should moderate starting this quarter and improve through fiscal year 2025. So if this scenario does play out, it suggests that the Bank of Canada might consider lowering interest rates to ease some of the financial pressure that we've seen on both consumers and businesses. And of course, if they do lower rates, this could help stimulate loan demand. That would be good for the banks. It would reduce the burden of high borrowing costs and support economic growth, which would then potentially at least improve bank profitability and reduce the need for these high credit loss provisions that we've seen so much of in the last number of quarters. Also, even though we've seen some recovery, the banks do still face challenges from slow capital markets growth, from wealth revenue, a slowdown in growth there, as well as ongoing restructuring plans, which have included a large number of job cuts. So as I mentioned, the banks have continued to increase their provisions for the credit losses. This is due to higher borrowing costs and inflation, and this has put a strain on the finances of a lot of their customers. I do expect this cautious approach to continue, particularly for impaired loans, as we've seen credit card delinquencies and business bankruptcies also on the rise of late. Also, homeowners are bracing for higher mortgage payments as loans come up for renewal at higher interest rates over the next few years. Finally, here, compounding the issue, loan demand from retail and commercial clients has actually decreased, largely due in part to the higher borrowing costs. So if we consider research that was done by CIBC analyst Paul Holden, he indicates that the loan growth will likely remain muted, sitting at around 3%. He suggests that lower affordability, deteriorating economic outlook will continue to get in the way of borrowers' willingness to take on new debt. He says loan growth is muted and will likely continue that way as a result of a higher for longer interest rate environment. So at the end of the day, what does this all mean for investors? Well, the slower growth and the continued negative economic outlook that we're seeing might prompt the Bank of Canada to hold interest rates steady rather than lowering them immediately. Now, as we're going to discuss a little bit later on in this video here today, that thinking truly is in the minority. The vast majority feel that interest rates cuts will be coming sooner rather than later. Regardless, investors, I think, should remain cautious when investing in the Canadian bank stocks. Earnings are going to improve, no doubt, over the long term, but the slow loan growth that we're seeing, the current economic factors, might lead the Bank of Canada to hold interest rates steady, which, of course, would then hold back profitability, at least in the near future. Looking for a smart way to invest your money? BMO ETFs and mutual funds offer a range of solutions for different goals and objectives. So whether you want to diversify your portfolio, whether you want to access innovative strategies, or maybe align your investments with your values, BMO GAM has you covered. Learn more about how BMO Global Asset Management can help you achieve your financial objectives with confidence and clarity. Visit bmogam.com today. That's bmogam.com today to find out more. Also providing support for today's episode is Qtrade Direct Investing, which is the winner of the top spot for the best online brokerage experience for Canadian investors. If you're looking for a brokerage account, explore their suite of offerings, including 100 commission-free ETFs, real-time quotes, advanced portfolio analytics, stock screening tools, analyst reports, and more. With over 20 years of experience, Qtrade is trusted by self-directed investors. With instant account opening, their platform makes it easy to open and manage your accounts from anywhere. Plus, get $50 upon opening and funding a new account, up to $150 for 3 accounts. Join Qtrade now, link in the description box below. Statistics Canada has released Canada's April inflation numbers, which we saw a cooling of inflation to 2.7%, and that's down from the 2.9% that we saw in March. Pretty much in line with what analysts had expected. Looks like we're going in the right direction. This report is in line also with what the Bank of Canada's expectations are, that inflation is going to remain close to that 3% level for the first half of this year, then falling to 2.5% in the second half of 2024. It also puts us now at a 3-year low. It's the 4th consecutive month now with inflation falling within Bank of Canada's target range of 1% to 3%. So in contrast to the views that I shared in the previous story, this has led to considerable speculation that the Bank of Canada may cut rates as early as next month. The next Bank of Canada rate decision comes in a couple of weeks, June the 5th to be exact. Joining those who believe that the bank may be ready to make a cut is Royce Mendez. He is the head of macro strategy at Desjardins Securities. And he says Canadians look likely to get a small dose of rate relief in the coming weeks. If we look back, of course, from March of 2022 through to July of last year, we saw the Bank of Canada aggressively hike their rates from a low of 0.25% all the way up to 5% where we are at today. The obvious goal here was reducing demand, and that would bring inflation back to that 2% target. When we look at core inflation today, which excludes the most volatile CPI movements, we also see a downward trend. Core inflation came in at 1.6% in April. That's down from 2% that we saw back in March. It's now at the lowest level in 3 years. It's also down from a high of 6.2% that we saw in June of 2022. Again, according to Mendez, Canadian central bankers should have the evidence they need to start easing monetary policy. Some key inflation figures from April. Good news for those of us who like to eat. We saw food prices slowing. We saw them rising 2.3% last month compared to 3% in March. Those are year-over-year numbers. Grocery prices rose by 1.4% annually. That's down from 1.9% that we saw in March. And even restaurant prices, the rise slowed. They came in at 4.3%. That's down from 5.1% year-over-year last month. Shelter costs also eased slightly. They were up 6.4% year-over-year, and that compares with 6.5% in March. But rents increased by 8.2% over the past year. We saw Alberta coming in with a 16.2% rise year-over-year. So that's hitting Alberta residents pretty heavily. Clothing and footwear prices dropped by 2.6% year-over-year. And on a monthly basis, we saw consumer prices rise by only 0.5% in March. That was driven a little bit there by an 8% increase in gasoline prices. Now, if we look at the current market expectations that are measured by interest rate swaps, we see a roughly 60% chance of a rate cut in June. If not by then, there's certainly an expectation that rates will cut by the July 24th meeting. So this is probably pretty good news. But before we get too excited about this, I'm sure that any rate cuts will be gradual. So I wouldn't recommend running out and loading up on credit card debt just yet. When I was still working as an investment advisor and a portfolio manager, one of the economists that I followed very closely was CIBC's Deputy Chief Economist, Benjamin Tull. He is insightful, he's very entertaining, and he has a great track record of identifying what might be coming down the pike. At the start of this year, he made some pretty bold predictions, and one of those he included was that the Bank of Canada would not cut rates in this spring. At the time, that was actually contrary to what the market was expecting. Of course, as we know now, that forecast proved to be correct. Today, he's updated his outlook on economic growth, its key drivers, potential stock market implications, and I want to look at some of his key thoughts and insights right now. Starting with inflation and rate cuts, he addresses the complexity of measuring inflation with various metrics like CPI, core CPI, median CPI, etc. And he emphasizes the importance of understanding that the narrative determines the data, not the data determines the narrative. And by this, he means that the Bank of Canada can justify its stance based on different inflation numbers. Tull believes that inflation is now low enough to justify a rate cut in June. He notes that core inflation, excluding mortgage interest payments, is already below target. When he talks about economic growth and recession, he points out that the first quarter GDP growth was stronger than expected, but was driven more by supply chain improvements rather than actual demand. And he says that the Canadian economy is in a per capita recession, with GDP per capita growth rates nearing those of past recessions in 1991 and 2008. He contends that the overall economic weakness justifies a rate cut, again expecting the Bank of Canada to start easing monetary policy next month. Now, when it comes to the U.S. economy, he says that the stronger than expected economy that we're seeing there is showing slowing signs in the labor market. And he compares the current situation to the soft landing scenario of 1995, where the Fed raised interest rates significantly, which caused a mild economic slowdown, but without a crash. And he is forecasting a similar outcome for this year, suggesting that while the Fed might hold interest rates up higher for longer, cuts, of course, will eventually come. He does predict the Feds will cut rates twice this year in September and December. On the Canadian dollar front, he believes that it has stabilized around 71, 72 cents US, and that is factoring in the anticipated Bank of Canada rate cuts ahead of the federal cuts. When he looks at the potential risks and surprises, he says that one of the biggest risks for the U.S. economy is persistent inflation. For Canada, he does foresee challenges if the U.S. economy remains strong and the Fed delays rate cuts further than what he expects now. This will put the Bank of Canada in a very challenging situation there. And he concludes that while he expects downward pressure on profit margins, the market must adjust, indicating that potential volatility still lies ahead. So if I had to summarize his thoughts and his insights, he is suggesting a cautious but strategic approach to upcoming monetary policies. He's placing an emphasis on the importance of understanding underlying economic narratives and their impact on inflation and growth. As I said earlier, it's great to be back. On Saturday, the next edition of our Pulse newsletter will be going out. I invite you to subscribe to that. I'm going to make it easy for you. I will put a link in the description of this video. As always, thank you so much for watching. We'll see you soon.